Good afternoon, everybody. A pleasure to be here to moderate this panel. As I was kind of thinking about the theme of this panel, driving the exit, talking to Colorado entrepreneurs who have had early exits or on the path for early exits, and then I thought about the keynote speaker, Basil Peters, this morning. There was a lot of discussion about anecdotes and case studies and about how hard it is to have hard data. So that kind of made me excited for this panel, because what we really have here is some great Colorado entrepreneurs who've had experience with early exits and thinking about early exits, and we're going to get a chance to use their case studies and their knowledge and their experience to really add to the conversation here today. So I'm excited for this panel. First panel after lunch, no pitches, so we'll try and keep it lively and make sure everybody stays awake and that there's no food comas. So with that, I'd just like to bring up the panel, and I'm going to have them actually individually introduce themselves, but I will list them off. We have John Spiers, founder and CEO of NextGen Storage. Thank you, John. And then we have Heather Callender-Potters, the co-founder of PharmaJet, and Dave DuPont, the CEO of Team Snap. So thank you very much for these panelists here today. And what I'd like to do is just have them give an introduction of their background.
Testing. Do you want me to use this?
Whatever you guys are more comfortable with.
I guess I'll go ahead and start. I'm John Spiers, a serial entrepreneur in the data storage industry. I started my career back in 1984 developing the first Winchester disk drive for the IBM PC personal computer, so that's how that kind of dates myself, I guess. But we'd sit around and argue whether a PC would ever use more than 5 megabytes of storage or not. My first startup company, I was working at Maxstore at the time, and when we started Left Hand Networks in 2000, and we grew that to a very successful business and ended up being acquired by Hewlett-Packard, and we pulled the band back together and started a company called NextGen Storage, which was acquired early on. I guess that's an example of an early exit in my career, and we ended up with the company again. We've been through 2 acquisitions and a spin out, so a little bit different than the typical early exit and you kind of go away. But again, all my background's been in the data storage industry, but have a lot of experience also with angel funding and have involved with many of the startups in town here.
My name is Heather Potters, and my background started out in private equity, and I've had responsibility of 3 closed-end funds, but actually in Central and Eastern Europe and the CIS. I'm originally from Colorado, and it's nice to be home. Been back here for about 5 years, and so I did the reverse, which is to go from coming to the quarterly board meetings and investing and having high expectations and helping our entrepreneurs to the other side, and boy, is it different. I have mostly early stage experience, but when I say early stage, sometimes it was kind of concept and startup, but it was in a place in the world that it was pretty obvious if you don't have telephones and you put in a telephony network, people will make phone calls. That experience led me to begin investing to migrate away from living in Warsaw, where I did for 19 years. And one of those investments brought me back here. So I have a medical device business, and my whole family comes from healthcare. We have a needle-free injection technology. We focus on immunizations. And perhaps one of the reasons why I'm here is not only have I exited, although not PharmaJet, which is my day job, but I've exited a number of businesses at various stages and things. And I've also raised money only from high net worth individual investors and family offices. So a little bit like the crowd here today. And it's just great for me to be able to be participating, because I was here last, was it March or April? And am the proud recipient of some of your money, a few of you in the audience today. So thank you for including me today.
Thanks, Heather. My name is Dave DuPont. I'm the CEO of Team Snap, which is a software platform for managing groups and teams. I suspect some of you in the audience are probably our customers or have kids that are on our teams. I blame John for getting me on the path of starting my entrepreneurial career. For the first 15 years of my professional career after business school, I was with a number of big companies, primarily Hewlett-Packard, in their personal computer and workstation businesses, about half of that time in France and the rest in the United States on the West Coast. John and the founding team of Left Hand Networks enticed me to come to Colorado for the first time, and I never left. I have been involved in a number of entrepreneurial adventures since the time with Left Hand Networks, and have been doing this for about 6 years now. Technically speaking, I guess I've never had an early exit, although exits are on the mind of anyone who is associated with the entrepreneurial world, and if they're not, investors will bring up the topic. So I'm delighted to be here today and to talk more about this subject.
Great, thank you all for those introductions. So I'd just like to ask each of the panelists in turn to explain how the concept of an early exit has impacted your career, whether you've done an early exit or not, whether you have a current venture that you're thinking about an early exit for, or if you have friends, colleagues, and associates who've done early exits. Just take us through a little bit of the details about how the early exit concept applies to your career. We can start with Dave. So,
since I've got the microphone, I can start. I guess I would say that early exits, or the concepts of early exits, has actually focused my attention on what's important. So I would say all the discussion around exits has caused me and my company, and this is especially true of TeamSnap, to focus on providing value and to focus less on necessarily exiting early. As we'll talk about, I think, in the course of our discussion here, an exit is a function of many factors. And I believe that the best way to provide value for my employees, my shareholder, and myself is to build the absolutely best solution that we can. And whether an early exit occurs or not is a function of many circumstances. That said, the discussion about exits in general has caused me to focus on making sure that I create the circumstances that result in an exit, most likely at some point. Whether it happens tomorrow or a year from now or 10 years from now, we'll see. But I believe that, again, to repeat myself, that the best way that we can approach exits as a company, and me personally, is to build value.
So I think that there's a life cycle to businesses, and sometimes you need to look at when it's appropriate to exit, and then I think there's a market timing and opportunity. There's also then overlaid on top of that how the public markets are doing and how much cash is sitting on the balance sheet of all the corporates that come in and typically buy things, or if there's a vibrant market for public flotation. So if I look at some of the exits that I've had, I think more often than not they are trade sales because companies, there are not very many Googles around, right? So there are companies that tend to be building blocks for other businesses, and my needle-free, I think, is one of those. But there's also opportunity where you can become a consolidator. It takes a lot of courage, and I think John's had a lot of public market experience. But to be able to become a consolidator at an earlier stage in an industry that's really taking off and gather those building blocks, perhaps that's also for transition to someone else. The last little comment, I guess, is that you always have to be prepared. So sometimes timing's not optimal. Sometimes you don't have a choice. So if your house is in order and you're able to make sure that you can move quickly, I think that's important because it also isn't necessarily that you're the only, date available. Many times when there are acquisitions going on, you're not the only one that somebody might be looking at.
Yeah, I tend to agree with Dave. I guess when you start a business, you have an exit, somewhat of an exit strategy in the back of your mind, or at least dreams of an exit, or thinking about, who you're competing with in the space, who might be interested in your technology or product, and then, what an exit strategy might look like when you start a company. But most of us are focused on building a great company, a great brand, and getting out there and being a successful business. And a lot of the follow-on potential takes care of itself. The 3 exits that I've been involved with, one in early stage, one in later stage, and then as an investor, I just recently had an exit with a company called Kraft, which some of you guys may know. But in all 3 cases, it involved a strategic partner. So, for Left Hand, it was our strategic relationship with HP. For Next Gen, it was our strategic relationship with Fusion.io. And then Kraft, one of the founders there, Kraft was a top developer at Oracle, and consequently, they were acquired by Oracle. Go figure, right? So, a lot of these exits end up being the result of, especially early exits, being the result of your relationships in the industry, and whether there's any complementary partnerships that you're involved with as a company, whether it's a supplier, vendor relationship, or whether it's a competitor, co-opetition kind of a relationship, or what it might be. But again, it's hard to predict these things, and you can't put a timeline on them, and they tend to happen naturally. But that's the key advice I have for people is to focus on your business and not worry about your exit strategy.
So we just heard from the panel about some key aspects of exits: building value, focusing on your business. Are there other predicates if you do want to do an early exit? Are there other factors or predicates? We've heard about strategic partnerships and complementary companies. You also hear a lot about companies like in Silicon Valley, like Google and Facebook, buying companies for talent. So is there a talent predicate? Is there an intellectual property predicate for getting an early exit? What are some of the ingredients you all think are predicates for having an early exit?
If you own Park Place, there's only one Park Place. So I think getting it right and getting your footprint right is really helpful. So it was Peter that was talking about 15% of the exit value, is this, and 35 is that, and et cetera. I think that first you have to come up with the concept and why it's unique or different or why you can do it better than someone. But then I think you have to plan for all of those things. And not in every industry is there maybe a universal theme. In my business, somebody would acquire us because we've got happy customers and people like getting their shots without needles. And then they would acquire us for the IP and the fact that we can do something that's very unique technically.
I like the Park Place analogy, and that certainly applies to us. I think to generalize the comment that trying to establish an unassailable position in the marketplace is a good place to start. That's what we've done over the last few years with TeamSnap. We're by far the world leader, and it came from focusing on providing a really valuable product for our end user customers. And if you do a good job of that, you're going to be able to derive some value from that. I think the second piece, which John has certainly experienced, is developing strategic partnerships early on that have the opportunity to both improve your product overall and add other benefits like distribution. In other words, give you access to a wider audience. Those are two components. I think there are some other aspects as well.
Yeah, I think in the example of the 3 companies that I've been involved with that have exited, in all 3 cases, it was innovation that filled a gap in a product line with a strategic partner. And so innovation is so key, especially in my industry, in technology, computer-based technology that moves very quickly. And big companies have a problem innovating as quickly as startups. Startup teams are very focused and very innovative and develop products much quicker than these big behemoth companies. And so, that opens the door for acquisition. If you have a product that's competing and differentiated from the products that a bigger company has, they would look to potentially acquire you or acquire that technology. Having sales and market penetration is also key. You see a lot of companies that are developing great technology, but they've failed on the sales and marketing side of the business. And those companies aren't, in my in my opinion and in my experience, aren't acquired as often as companies that also find the route to market and are able to execute on the sales and marketing side and grow revenues. Because at the end of the day, that's what you're being bought for, is your revenue growth or revenue growth potential for a bigger company.
Well, one of the things that I've noticed in the conversation so far today about early exits is there's been a pretty general idea of early exits being applicable across multiple business types, across multiple sectors. And we have a panel that does represent a diversity here of business types, everything from life sciences, which have obvious medical, which have obvious regulatory pipelines that they have to pass through, to hardware companies, and then you can think of, digital media companies, which may have, shorter timelines to market. And I'd just like to ask the panel if they think the concept of early exits is applicable across all different business sectors, and if it is applicable across all sectors, how does it sort of change when you move into a sector that has an inherently, larger capital spend or longer time frame to market? So I'd just like to get feedback on early exits across sector types.
Yeah, I guess I can start with that. I think the timing of exits has been mentioned a couple of times here, is a function of many factors, and those factors vary across industries and times. Capital availability differs not only across industries but also over time itself. I believe that all of that has to be taken into account as you move forward with a company. In the case of my business, it's a software as a service business. At this point, capital requirements are relatively low compared to, say, John's businesses that he's been involved in, or some others, and therefore the opportunity to continue for a while and to build a brand and to build more value exists more in my industry. Whether that will last into the future as sales and marketing costs to continue to expand the brand are likely to increase, we'll see. But I heartily agree that the circumstances for exit at any point are going to vary across sectors.
I would have answered this question differently 5 years ago. But in the medical device industry, drug development industry, the timelines have increased by 50% in the last 5 years, roughly, because of the FDA requirements. And that's not a universal in the rest of the world. But typically in our business, you need 2 years minimum working really hard to go from concept through to a device, and then you scale it. And it's about $5 million in capital expenditures to do all of that. So if you factor in, then you have to go create it, then you have to go get it approved with regulatory, and you may have to do a little bit more, which is lately the mantra of safety and efficacy proof for medical devices. You're probably not going to see something happen until you've gotten out of the gate and you have some customer experience, because acquisitive other device manufacturing companies are buying technology, but they're also buying customer loyalty and market share. So I do think that the answer is that it really depends greatly on the industry. And I've been involved in everything from heavy industry to service businesses. And I think if you get closer to either the service side, the software side, or something that doesn't quite take as much capital or overhead, it's an easier thing to exit earlier.
Yeah, that's an interesting thought. Government regulation certainly extends the timeline of a company's progress and execution, and can obviously prolong any kind of an exit opportunity, and the healthcare industry obviously is a good example of that. In my industry, technology, it moves very quickly. There's less regulation, although there's a ton of competition as well. If you get FDA approval on a drug and it cures cancer, and you have patents around that, obviously you could be in a situation where there's no competition whatsoever, which is pretty attractive. In our business, it's all about innovating, getting to market quickly, generating revenue, and proving your business model before you get to that point. So I think exit opportunities varied a little bit across industries. With tech, it's fairly standard. That there's manufacturing and ramp times and certifications and things like that you need to go through. Obviously, those timelines need to be added to a business growth strategy that ultimately may push out the timeline for any kind of an exit.
And our panel here today is a seasoned group of entrepreneurs who've all been through sort of multiple cycles of companies and also multiple time frames that have gone on in markets. And one of the things that came out of Basil Peters' conversation was an assertion that sort of people are changing their attention spans, and that, you know, technology and innovation are happening more quickly. The internet has facilitated that, and innovation is happening more quickly, and you have to be ready to exit quickly to sort of avoid being overtaken by a competitor. And I was wondering what the panel believes in terms of, during the course of their careers, has the need for quicker innovation and earlier exits, has that increased due to the pace of technological change increasing? And have you seen sort of changes over time?
Okay, so I've I mentioned earlier that I was with Hewlett-Packard, and I come from an industry of rapid change, and I've lived through a number of major technological innovations and seeing companies come and go as a result. When I started my career, the mini computer was kind of king, and DEC was ruling the roost, so to speak, along with IBM. The PC companies killed that, and I would argue even within the PC world, there were some major changes there as modes of distribution changed with the internet and Dell, the rise of Dell, and then other devices have made the personal computer, at least the desktop personal computer, even obsolete. So, you know, looking back on even the big company part of my career, I've seen the effect of what you're describing. In the small company part, so TeamSnap in particular, I'll talk about that. We've seen some major technological innovation even over the last 5 years and change that we've existed. When we started, we were a website or a set of websites for Teams. And now 90% of the interactions with TeamSnap are taking place on mobile devices. We've become a mobile company. Now, I think early exit is a mechanism for dealing with change that you maybe haven't anticipated or can't address. In our case, we recognized the change and embraced it and put out a product and have really doubled down on that product over time. And I guess I'd like to say one more thing here. There's a calculus that I go through, and I suspect my fellow panel members go through continuously, which is, I'm always thinking for myself and my shareholders about the opportunity that we have moving forward and the risk that we won't be able to actually seize that because of competition, because of change, because of potential changes in access to capital. But it's that continual calculus that causes me to say, okay, I think we're, for the moment, in this for a while longer. And that's likely to change at some point, but it's hard for me to predict when that will be.
So again, I have to qualify things by saying my industry is a little bit different. You build it, you take a lot of risk, you bring it to market, and then you have really sustainable barriers to entry. So it's not so much that somebody's going to be following you, but there are alternatives. And if you can find that segment and niche that you fit in really well, you can create great value that somebody else just simply wants to acquire because it was hard to do in the first place. But I was explaining to somebody last night that when I lived in Poland, they have this driving etiquette where you have a 2-lane road and then dotted line on the shoulder. And what you're supposed to do if somebody zooms up behind you is you're supposed to drive full speed on the shoulder. And you've got people walking, you've got cows coming in from the farm, tractors, people on bicycles, and you may have somebody doing this the other way. So you're constantly looking in your rearview mirror and you're constantly looking ahead of you to see what's coming and what you're going to hit. So I think that's probably the rule of thumb today if you think about the pace of change and the difference in the way people think and adapt. And the internet is exploding globally, so it's not just a US playing field anymore. And it doesn't really matter, I think, which industry you're in. If you're not looking behind you and looking ahead of you and trying to predict 2 and 3 years out, you're not doing the job that you should be doing.
Yeah, I think social media and the communication vehicles we have today certainly drives the pace of innovation and ideas. Every great idea I've ever came up with, I guarantee someone else has thought of it before me. And I run with that in mind, knowing that they could potentially beat me to market, if they were to execute on their strategy and that technology. So I think, the key to being successful and to getting, getting to market first and getting awareness and executing our strategy is crucial in developing value and ultimately being attracted by potential acquirers. And social media is a big thing, right? If you look at the way we did advertising back at Left Hand and market awareness, it's completely different than what we're using today, right? We have a social media team that's, talking about the product, talking about customers, blogging and marketing on our behalf, and those types of things are what other customers see versus, it used to be downloading white papers on a website, or maybe they went to a lunch and learn event at one of the channel partners and things like that. A lot of customers are doing their research online today and making product decisions online, and so the more, the content of your website and the more educational your websites are, the more you can drive demand and growth. So yeah, things are changing from the dynamics of how you acquire customers, how you get your message out there, and also more and more potential acquirers are looking at your success and what you're doing out there online and getting almost instantaneous feedback on the success of your company. So things are moving very rapidly, and you need to think about all those things as you build a company.
One possible lens through which to think about exits could be the financial lens and the idea of net present value and expected value for the entrepreneur and her shareholders. This idea that you might take less money now but have more certainty and get that money, or wait a few quarters or a few years and go for a bigger exit and a bigger payoff. I'm wondering how the panel, how they think about those financial trade-offs as they're building their company and planning their exits.
Yeah, in our sale, my last company, NextGen, which is also my current company again, when we sold that company, we had an offer from Fusion.io for $119 million, and we were 2 years into it with only about $2 million in revenue. We had a board of directors. We had a couple of VCs on our board. We had raised $12 million in venture capital. And so when you go to make a decision as to whether you want to be acquired or not and go through the acquisition, you think about a lot of things. You think about who's acquiring you. We believed as a company, and even the engineers were very excited about being acquired by a great technology company, and we had similar cultures, and we really liked the people there, which was a huge positive. On the negative side, we thought, well, if we're getting this much attraction for our technology this early on, let's go continue to execute, and we'll have a much bigger exit down the road. A lot of these decisions are really hard to make. Of course, your board of directors and the level of ownership of your investors has a lot to do with it. A lot of times, it may come down to a board vote, and if you're not the majority owner of your company, then a lot of exits can happen, even though you may be against them. But typically, the CEO and founder of a company, even if you're in a minority position as far as ownership, investors tend to look to the CEO and to the team as to what they're feeling, because what they don't want is an upset team and a team not willing to make the transition to whatever company is being acquiring your company. So having everybody on board with the decision is very crucial, but there's a lot of dynamics that play into it. There's return on investment. We delivered a 8 to 10x return to our investors with that deal, and these are smaller venture funds that a 10x return for a smaller venture fund is huge, and they're not growth capital guys, and that's another point we may be talking about a little bit later. Is a lot of the VCs in the Boulder area are very small VCs, and so they're looking for smaller exits, and typically only get smaller exits. Now, there's some situations where some big East Coast or West Coast venture capital firms may come into one of their deals and then provide expansion capital and take a company to the next level. But a lot of these guys are if you look at their portfolio and history of exits, their companies tend to exit more early than late in the cycle, mainly just because of their investment thesis and what they're looking for, and and the return to their investors. So there's a lot of dynamics that play into the situation.
I kind of want to answer with my equity background versus entrepreneurial background. I've seen exits happen and helped kind of orchestrate some of those things, and I've seen great transitions, and I've seen wipeouts, and I've also seen management teams have to plow back in their ownership into the next level, and then the new owners run them, rough, and it's just a disaster. So I tend to think about not only is gathering the right capital important, because you have to have a great relationship with your investors, and it's the for better, for worse thing, right? You sign up, and it's a journey sometimes. But it's also the other way around, that unless you have a business that is just a bona fide block of activity that's going to work no matter what, there is that transition relationship. And in fact, that little video that we saw up here, I kind of wondered how it's going on the other side, because it seems like not only did they sell, but they had to keep working. So it probably isn't a universal truth, but I tend to believe that you need to really leave a little bit of value so that whoever's buying your business has that rest of the upside. They probably know what to do with it, otherwise they wouldn't make an offer. But it's important to have a good transition, because you built a business and you want to see that go off and thrive and live.
Yeah, I wouldn't have used the term discounted future value or present value of the business moving forward in terms of assessing an exit. But when I talk about the calculus and risk, that's really what I'm talking about. And John was particularly focusing on the capital factors relating to that. But there are others, and actually there are other capital factors as well. We, for instance, just raised $10 million. So my attitude toward a potential acquisition today is going to be different than it is, say, 12 months from now, when I've potentially burned through a good portion of that $10 million. Ideally not, but potentially. And in addition, there's the function of competitors. What's happening out in the competitive environment? Are there new ones, innovators, and we've got a couple of those? Are there established players that are starting to acquire other companies that make the opportunities seem less interesting? So I do think about, personally, the risk associated with what I expect the company to be left to our own devices in the next 2 or 3 years, and plan accordingly. One of the ways that I apply that in everyday life is to think about, we have a certain valuation that is a function of raising capital. So I know how much my company was worth to investors just a short time ago when we agreed to a valuation. That gives me a yardstick with which to measure acquisitions. Now, I have to take all these other factors into account, but it's at least a yardstick. So at this point, I tend to think of acquisition offers as, well, if I'm going to do this now, it's got to be a multiple of that. Now, how much of a multiple, we'll see. But that's the way I think of it, and the nature of the multiple changes over time as my cash reserves go down, as potentially the financial environment changes, as other factors come into play.
Add something. So I think that there are some acquirers out there that are buy or kill, right? And there are some that are genuinely interested and don't want to have to recreate the wheel. So the things that we're all talking about are not universal truths. And the best advice I can give you is, if somebody's knocking on your door, you should be flattered, but you should just reach out and make sure you've got a whole bunch of people surrounding you that give you a frame of reference. Plus, you're also so close to it, right? It's your baby. And you probably need to make sure that you have enough counsel that you don't screw up.
So John alluded to different types of investors and different capital structures. And if someone's thinking about pursuing an early exit strategy, I wondered if the panel could give us advice to an entrepreneur to think about different capital structures. And I know there's a whole panel or a whole debate on VCs versus angels, but you have bootstrapping, angels, venture capital, later stage private equity, debt, all these different financial structures, and then within those investors, different structures in terms of how you structure your equity investments. And so I was wondering what kind of factors, what kind of advice the panel would give entrepreneurs about what kind of factors they should think about when they're setting up their financing rounds to allow for an early exit.
Yeah, that's a fairly deep topic. I mean, we could talk hours about that, right? I mean, generally speaking, at least my personal opinion is that an angel-backed company, which many companies get their start with angels, it is a great way to get going. I think angels tend to be more supportive and hardworking with you. A lot of angel investors like myself have entrepreneur backgrounds and can help entrepreneurs get going and help them look out for the blind spots and even bring resources, not only capital resources to the table, but human resources and connections and things that can help your business grow. At some point in time in your company life cycle, angels can't fund your company forever. If you plan on being a billion-dollar company, chances are you're going to need more than just angel investors, unless, maybe one of your angel investors is Bill Gates or something like that. You're going to have to bring on institutional capital. And institutional capital, the nice thing about institutional capital, when someone values your company and it's an institution, that's much more credible than angels valuing your company. In fact, when you bring an institution in after several angel rounds, they tend to discount the valuation that the angels established, which isn't, which may keep you on the path of being angel funded even longer because you're not willing to accept that valuation. So that's something that everybody should think about. When's the right time to bring on investor capital, institutional capital, and institutional capital. Once you get institutional capital, then that opens the door to even sometimes broader relationships, and institutional money usually has relationships with potential acquirers as well and can establish those relationships. But it all depends on your company and your growth strategy, how much capital is required. I mean, there's guys that build billion-dollar companies with 2 to 3 guys in a basement or a garage, so with hardly any capital. And then there's companies like mine that need tens of millions of dollars to get going. So it really depends on what kind of business you are and how much capital you really need to be successful.
So I think in the very early days, it tends to be sensible that you have kind of convertible loan notes because you don't know what's going to happen. And you want to make sure that those early investors are protected and hopefully incentivized to continue on to participate and follow their money. I think that it's super important for you always to be aware of benchmarks and what's been happening in the marketplace, and then use a discount of those benchmarks back to where you are in your relative development and expected kind of financial trajectory to make sure that it's fair. Because ultimately what you want is you want everybody to be happy, right? You want to make sure that there's a fair return for everyone. And then I think lastly, there is a mentality among certain institutional investors that's driven by just who they are, that they've signed up limited partners and they've verified that they're going to go out and do deals in a certain way. And if you're desperate and you take their money, you may find that there are certain return expectations that they're factoring into the legal requirements of their deal structure, so that no matter what, they're going to hit their returns at everybody else's expense. So if you're aware of that before you even start, then maybe if you're lucky, you can be choosy about the money that you take or the kinds of terms that you take. Because I think at the end, unfair deals create such tension among shareholders that it really becomes very dysfunctional if you have to do that.
Yeah, about all I can add to the discussion is just to say that to the extent you've got a choice, you should really understand the motivations of your investors. Even within a class, they can vary quite a bit depending on just where the investors are located. I would argue that the motivations of a large West Coast based VC, for instance, are likely to be a little different than a Colorado-based venture capitalist. So it's important to understand just the nature of the motivation of the investor, where they are, how big they are, what kinds of people they raise money from, what kinds of expectations they've set, and it's something that one should explore. It frankly is one of the reasons why we chose to have our first venture-led round led by the Foundry Group instead of some other opportunities we had. Because I'm well aware of other companies in this area who have taken money from folks, to put it bluntly, for whom less than $1 billion exit wasn't interesting.
So excuse me, I'd like to follow up on Dave's last comment. Since we are the Colorado Capital Conference, we're located here in Colorado, full of Colorado entrepreneurs and investors. Is there a geographic dimension to early exits? If you heard Basil Peters speak earlier today, he kind of talked about the general value of early exits, and I think he would say that it's applicable across geographies. But given some of the comments here today, I wonder if being in a market like Colorado, you're not London, New York, or San Francisco, and the nature of the capital and the investors and entrepreneurs we have here, is this concept of early exit, is it more relevant in Colorado than it might be in other markets, or is it particularly relevant here in Colorado?
Yeah, that's an interesting question. I'm a member of the Blackstone Entrepreneurs Network, and one of the things that the Blackstone Group and that whole initiative talks about and discusses is how do we build unicorns in Colorado? There's a lot of history of companies in Colorado getting acquired early on and not taking these companies to the next level and growing them beyond several $100 million in revenue and really building billion-dollar corporations here in Colorado. And that's really what Colorado wants. It builds great communities, it builds job security, employment, and those types of things. So there's several initiatives to kind of understand this and how to take Colorado companies to the next level and attract capital and continue to grow them versus sell them. If you look at the number of companies that are sold in Silicon Valley versus here, I don't know what the statistics are. Obviously, there's many more startups there than here, so you would tend to see more acquisitions there than here. I don't know what the percentage of the total companies is that get acquired here versus there, but there is a history in Colorado of companies getting acquired earlier than most, and there's not a very there's a couple of examples, like Zayo Group is a big example of a company that grew to $1 billion valuation and did an IPO, but there's not a lot of those examples in Colorado, and I think there's a community developing that wants to encourage that and continue to grow businesses for long-term success, and it helps with the economy and helps with a lot of different factors. Although from an entrepreneur perspective, some entrepreneurs aren't comfortable running a public company or taking a company to that stage and love starting companies, and their excitement comes from building great companies to a certain level, and then when the bureaucracy kicks in and you've got 5 layers of management, you tend to lose motivation. At least that's me, and look for doing the next thing. So it really depends on the entrepreneur and what people think as well.
So my first reaction to that question was, well, I don't know, because I haven't been here long enough. And I think that if you look at the United States, and there's a West Coast pocket that's situated around Los Angeles and San Diego and San Francisco, and bioscience hub. Same thing on the East Coast, a drug corridor. There's also mass population kinds of dynamics that go into that, so you have a lot more industry in some of those places. So it really depends on what kind of business you are. But based on what I've seen here, I just think that the pace of innovation is amazing. And this is a really unique place where every single person reaches out and says, and how can I help you? And it's that community spirit that just is, so invigorating. And I think then you couple it with Colorado's a pretty great place to live. It would be nice if we can get big enough that we can leave more businesses here, but I think probably the trend will end up being that we're more innovative in the near term than longer term.
Yeah, I would respond to the question in this way. I generalize the question about early exits and how geography affects those to say that access to capital is not the same everywhere. And we don't have, frankly, the same access to capital that firms do on the West Coast or the East Coast. And we're not alone in that, by the way. The previous company I ran was founded in Israel, and at least until recently, Israel had a similar history as us, which is very innovative, lots of new companies, lots of interesting ideas that ended up being transplanted to the U.S. and then became big successes. And there are lots of examples of those around now. So my point is that, yeah, I think about access to capital quite a bit. I'm reminded of this when I go to the West Coast and talk to West Coast venture capitalists, many of whom have strictures against investing outside the Bay Area. For instance, Sequoia is very well known for only investing in the Bay Area. We don't have access to the same level of capital that firms do out there, and as a result, we behave differently, at least I do. Not just in terms of how I think about exits, but how I think about money and access to future money and how I spend my money now. I'm not counting on a $50 million or $100 million raise anytime soon. It may be possible for us to do that, but frankly, if I were in Silicon Valley right now, I probably would be playing that game, or at least leaning toward it.
So just a different dimension I'd like to ask the entrepreneurs about is the dimension of sort of personal factors that could affect, your exit strategy and whether you want to do an early exit. Are you okay with letting go of your baby before they become a preteen? How does an early exit and a series of serial entrepreneurialism, how does that affect family life and domestic life? What are the factors if you're an entrepreneur and you're older and you may not have that many more chances? Does that play into whether you'd want to do an early exit or not? And conversely, if you're a millennial and you're just starting off your career and maybe there's this idea that millennials maybe have a shorter attention span, does that affect early exits? And I don't know if that's really a true statement or not, but certainly there's that perception. So just what do these personal factors play into building your businesses and designing your exits, and how has that sort of impacted your exit strategies throughout your career?
Yeah, so obviously family plays a huge role in an entrepreneur's life. My wife was 6 months pregnant with my daughter, and we had literally no savings when I quit my nice paying tech job to start Left Hand Networks, and taking the leap of faith has to be done by your partner along with yourself, and have the same vision and belief in what you want to do. I guess so every family situation's different, obviously, but it does play a big factor into things. As far as exit goes, I don't really know. How the family gets involved. I could imagine a bunch of scenarios from everything from health to age to desire to, just go down the list of all the different things you can imagine. It could play a factor into whether, into an either early exit or hanging in there and wanting to take things to the next level.
So as the only woman on the panel, I can tell you cannot have it all. You have to take it in bits, or you have to have a tremendous support system. So same thing in business too. I don't do everything, and I just happen to be able to come and talk about PharmaJet, but I've got a great medical device team, and that wasn't the case in the early days. But if you have a supportive network, including family and extended family, I think that's really important. They're your go-to people when you have terrible days and you can't tell anybody about how awful it was. and I think they'll be your biggest champions to cheer you on when you're almost there. I'm pretty good at marathons. I've done a lot of those in terms of money in, money out of funds and businesses, because not everything ends up being fast, and I think you have to be realistic about how you pace yourself. So if you can pace yourself and surround yourself, I think you'll be in good shape regardless of the other factors.
Excellent point so far. The point I feel the need to underline is, in many cases, in fact, in most cases, it's not your call, or at least it's not significantly your call. So Team Snap now is kind of typical, I think, in that I'm probably the biggest, I think I am the biggest individual shareholder, but I'm not a majority shareholder. So ultimately, ethically, I need to act in the interest of the shareholders. That being said, there's certainly, on the margin, I'm a human being, and I have things influence me and influence my decisions, and a lot of factors come into things, like my age. Some of you might have noticed I'm not a millennial.
I didn't notice that.
Yeah, I forget the adjective that was used earlier, to experienced entrepreneurs or something like that. When I introduce myself, I usually say grizzled. But anyway, that certainly affects the way I think about my own company. Just the position it has in the marketplace, I think about that. I believe that my company is particularly well positioned for bigger and better things, and it's not obvious to me that in the 20-plus years I've got in my working life, or whatever it ends up being, that I'll find anything as good as this. So that kind of affects the calculus. My wife's thoughts about how much time she wants to spend with me, a bunch of other factors enter in there. But I'll go back to what I said at the beginning. Yeah, I certainly have influence on the decision of what happens to us and the exit in particular, but ultimately it's a group decision. The board and the shareholders have a significant role to play.
If we do have a few more minutes left, I'd like to offer the chance for the audience to ask some of our panel members questions. So I'd just like to put that open for a few questions.
And if we could just make sure to answer or ask the questions into the microphone. We have a few people on live stream. So,
Heather, you said something about making sure your house is in order. Could you expand on that a little bit?
So making sure that you've got an accounting system in place pretty early, and a good handle on your records is critical to making sure that when you're asked to do your first audit, you get through that pretty easily, because otherwise it can be a mess. Same with corporate governance, making sure everybody knows what they own, what you own. I mean, really, truly, most all of us start, and then before you know it, we're out of the gate and we think, oh, what did I spend? So even though most companies are not in a situation where they have a really heavy-duty CFO, it still doesn't mean that you shouldn't make sure that you know exactly where your documents are, exactly what your numbers are. And at the risk of slowing down a little bit, you need to make sure that those are in place, because they're every bit as important to your foundation and your exit as all the rest, in my opinion. And when you do take institutional money, they'll make sure that that's in place, and they'll make sure that's in place before they actually come in. So it ends up adding a cost burden for those of you that haven't done that yet. It's a really important thing that sometimes people underestimate. But I also think there's some wonderful alternatives here in Colorado of some part-time people that can come in and help you out, even acting CFOs, if you will. So it doesn't necessarily have to be that expensive, but it's a really important thing.
got time for about one more question.
Since the biggest topic is on driving the exit and early exits today, just in relation to your experience as panelists, have you guys always known when it's time for your exit? Is it sort of like that feeling that you get, I guess, with respect to how everyone says, when you find that one person in your life that you're going to spend the rest of your life with, you'll know? Is it like that for exits? So I guess in clarification, Obviously, every company's path is different, but for each of you, with respect to your own experience, has it always been a time to where you could comfortably say it's time to start looking at that?
Yeah, I don't think so. I think it's more of a blindsided feeling than it is I'm ready and, to take the leap and time is right and all the stars have magically aligned and I'm ready for this, It's not that kind of well, at least in my experience, it wasn't that kind of a event. A lot of it's just, I actually, in my last exit, we weren't looking to be acquired. In fact, we were raising around a venture capital. We had a term sheet in place. We were literally 2 to 3 weeks from closing on our round of capital, and I went down to meet with one of our strategic partners because he had mentioned that he wanted to make a strategic investment in our next round of financing. So I went down there and said, we're about to close the round. You guys want to put a couple million into this round as a strategic? And he said, can I take a look at the term sheet? And I showed him the term sheet, and he said, well, we're really not interested in investing in your company. We're interested in acquiring your company. And I said, damn, shouldn't have showed him the term sheet. But, but those are kind of the way things happen. If you go back to Left Hand Networks, it was completely different, right? We were growing the company nicely, very successful, but the market, this was November of, this was 2008, right? The financial crisis was in mainstream. The IPO market had dried up, so we were looking at filing an S1 and doing an IPO, but there were no IPOs getting done, and we didn't want to spend $1 million and go through the Sarbanes-Oxley requirements and everything else, and just to go out to market knowing that the capital markets had dried up as far as IPOs are concerned. All of our current investors were willing to continue to fund the company and grow the company going forward, but then it was more dilution for the shareholders, and then you weren't guaranteed necessarily a higher valuation even though you were growing the business nicely. Investors tend to value your company based on market comps, and market comps were dropping very rapidly. So we were in a situation where, well, we wanted to hire a banker and see what we could find out there as far as interest, and ultimately we were acquired through that process. So every situation's different. It depends on the market, depends on the competition, depends how well you're doing. Are you growing revenue, or is your company stagnated? And there's a lot of different factors that play into it.
Do we have?
I think, unfortunately, that's all the time we have, but thank you to our panel. Jeff, John.